Hello, everybody. Welcome to our Bursa Malaysia webinar. My name is Shen Chu. I'm the moderator for this webinar, where today we are going to discuss about 7 golden rules of investment. Okay, so as usual, if you can hear me, please go to the control panel and click raise the hand button. All right, if you can hear me and see the screen nicely, please go to the control panel and click raise the hand button. Excellent. We are seeing a lot of hands right now. You may put down your hands. Thank you so much. Yeah, so happy that we have this webinar again. Um, so before we begin, we just want to talk about disclaimer. Whatever we share today is only for educational purpose. In no way that we give any buy or sell call to any of the stocks. So none of us would be responsible for all the decisions that you make. Right. So this webinar is only for educational purpose. So now today we are very honored to invite a very renowned author, PC.
Hi.
Thank you for joining us today. And the person next to me, PC, he graduated from National University of Singapore in 1989. He has more than 26 years of working experience with several public listed companies and multinational companies. He's also a published author of 2 books, okay, in which author invests in REITs, which reached the Popular's top 10 non-fiction bestseller. You see that he's doing a book autograph session in one of the pictures shown here. And he is a full-time investor. That means he has no job. He full-time invests in the stock market.
I'm unemployed.
Unemployed by choice. So full-time investor, he's an author and trainer and been investing in Bursa and international markets since 1995. So he's a very accomplished investor. So welcome to join us in our Bursa Malaysia series where we talk about 7 golden rules of investing. Yeah. Now, what is our outline for today?
So what we'll be sharing would be learning how to identify your affordability level and how to start if you are new to investing. Now, this is very important because often we do not know how much we should allocate from our salary to begin our investment. Then the other thing is to discover the reasons for investing. Identify the key components to look out for before investing in a company. Recognize your own limitations. Identify rumors and understand why buying on the rumor and selling on the fact is often a trap for many investors. And I'm sure even sometimes seasoned traders, they also would fall into that trap because no one can actually say no when someone approach and say, hey, I heard a rumor that this company is going to do this. Okay, so even sometimes seasoned people can also fall into this trap, mainly because we can't check our own greed. Okay, then apply techniques learned to identify the traps of averaging down and how to manage it effectively. Now, this is very important because sometimes when we read certain books, they say you can actually average down so that your cost per unit of share is much lower than your previous purchase. Now that itself, although is a strategy, but it can also be harmful to your investment if, let's say, you do not know how to apply certain techniques. Mm-hmm. Then learn how to limit your exposure in risk by having a balanced portfolio.
All right, so why don't we start with, are these the 7 golden rules?
Yes, these are the rules that I actually adapt and adopted based on what reading I've come across and through my years of experience.
Yeah, so why don't we start with the rule number 1, which is understanding our affordability level.
Yes, so let's start with what is your affordability level. Now, according to surveys done by international companies and published in The Balance and Sachs, now these two are actually quite well-known research houses in the US. Okay, I'm using the US as an example because they are the most heavily invested community among other countries in the world. Okay, so on an average, the respondents have a 10 to 20% of income in cash for emergencies and invest another 10 to 15% in stocks. Now, So whether the percentage is 10%, 15%, or 20% depends on your own risk appetite. Now, if let's say you are definitely a very high risk taker, sometimes you may even push your affordability level up to 30 or even 50%, but that is not how you should do it. If you are very new to investment, always start on a very sound footing and on a conservative note. So if we adopt a 20% cash and 15% investment view, if your salary is 3,000, okay, so you will have 20% or 600 in cash, or 15%, 450 ringgit in investment. Now that 450 ringgit is your affordability level.
Right. So you suggest that we either take 10 to 20% from our income to invest.
Yes.
In
to start off, because if you have allocated 20% as cash on standby, okay, this shall be your reserves, okay, so that if you put all your money into investment in the time of emergency, then you might have to force sell your shares, okay, to have the cash ready for certain emergencies. Now, then, if let's say the stock market is good, then yes, you can still exit with a profit. But if let's say the stock market, has been on a downtrend, then if you are in need of emergency, then you may have to sell your stock into a loss, and therefore your investment will not be a very fruitful venture. Okay, so always allocate some cash as a standby.
Yeah, is 450 ringgit enough?
So, well, let's look at it and see. Now, 450 ringgit may limit your investment choices. Why do I say so? Because if let's say at 450 ringgit, you are able to buy 100 shares up to a limit of maybe about 4 ringgit and 50 cents, 450 ringgit. Okay, which means that share will be 4 ringgit and 50 cents if you're basing it on 100 shares. So you will not be able to buy much better stocks, especially those on the large cap as well as blue chip. So here I show that, if you have a decision to invest, okay, and if let's say you invest in small cap, definitely your risk is actually much higher. If you invest in mid cap, then your risk is gradually lower. But if you invest in blue chip companies, those with very strong balance sheet, those that have very strong cash flow, those that are very profitable company, then you might not have that amount of money to invest in those stocks that are much more higher price. Okay, but these are often the safest stocks as well. So that's why it is prudent to save the amount, okay, until it reaches 1,350 or 1,800 to enable you to buy some large cap or blue chip companies, which also help to reduce your risk. Okay, if sometimes we start at 450 ringgit, then we say, okay, I buy a 50 cents stock, okay, and then I can buy let's say 900 units of the stock. Yes, you can buy 900, but then is that stock able to give you that kind of return? Is that stock risk in your investment reduced, or has it gone up higher? So that's why, if you have a much larger amount of money, okay, then you can actually also split, having a blue chip and maybe a mid cap, rather than just focusing on a small cap, right? Because the smaller cap it is, the higher the risk will be.
So you're suggesting that if we're new to investing, we should should consider investing in blue chip first, because that brings more stability.
Yes. Also, some blue chip companies actually give very, very good dividends. So we can start off with some steady income in return. Okay, but you must remember, the moment that you invest, you are partaking in all the risks that comes with your investment choice.
Yeah.
Okay, investment is never risk-free. Okay, all of us in our investment journey, we have made money, we also have lost some. Okay, some have even lost higher. Okay, simply because we often easily being overwhelmed with greed. Okay, and also because we never allocate enough money, and also we go beyond our affordability.
Yeah. If somebody say that this asset confirm make money one, that one you need to run faster, right?
Yeah. So sometimes people say, oh, then I silent, I buy even more. Okay. So these are often choices that we make, but as soon as we make a choice, we are already partaking in a risk.
Yeah.
Okay.
So the word guarantee, this is something that we
there's
can
no such as guarantee. Okay. So next, so always remember, investment is not a risk-free venture. Okay, investment carries with it risk. Okay, it is not totally risk-free. This is something that you must always remind yourself. Okay. So it is prudent, therefore, to read the quarterly financials diligently. Now, sometimes we invest into a company because we have read its financials, and then we then decided that, hey, I read the financials, and I've decided that this is a good company, and therefore I will invest. But sometimes we only read it once, and that seals our investment decision. But to really see whether your investment will be fruitful over the long run, you need to read the quarterly financial diligently, which means every time it comes up, you have to check how's the company performing. Okay, because as soon as the company starts deteriorating in its performance, then you'll see a lot of people lagging interest in that company, and therefore the share price would actually start to decline. So making that investment decision is not a one-time read. Okay, you need to maintain that consistency to read regularly so that you know what's going on. Okay, so sometimes a bad investment decision can result in a complete wipeout of your entire investment. If, let's say, okay, you fail to read a report which suddenly says that the company is facing a huge litigation, or in that its venture has failed. Okay, because you will miss it if you don't read it regularly. Okay, so then it becomes a bad investment. Okay, so in short, never invest what you could not afford to lose, because starting an investment journey, you must always have that philosophy in you that you can afford to lose. Okay, if you have the thinking that I must win, okay, then your philosophy, okay, is too far right. Okay, which means you're always thinking of winning. Only when you think that you could lose will then make you more self-aware of the risk that comes with it. Because if you always think that after doing certain thing and it's a sure win, okay, there's no such thing, because companies can perform over a certain period and then something bad might happen. Okay, let's say a financial crisis, and then that stock might fall. Okay, or the company suddenly face a huge problem. Okay, over the years, the introduction of new technology often can result in a company, okay, being worth zero. Okay.
Because like what you said earlier, sometimes if you win too many times consecutively, humans, we have emotions, and sometimes we'll be more arrogant. So when we become arrogant, or we become complacent, so the next time we maybe trade even higher amount. We keep increasing amounts, then the one time the market meltdown, then you totally lose all those savings.
If you can afford to lose that amount, and you also have a cash reserve, then you can always start again. Sometimes people lose everything and they can't start, and they can't start over again. They have to sell their house. Okay, they have lost that financial security. So always track, okay, with an awareness of the risk. Okay, and always allocate cash for emergency, and then trade within your affordability level.
Which is precisely because if you invest in something that you cannot afford to lose, then you will get emotional about.
Yes.
You get emotional about
it becomes a gambling. For whatever you lost, then the next trade you want to double down so that you can get back your loss. And this then is no longer an investment strategy. It becomes a gambling habit. Okay, so that's why you need to distinguish. Investment means knowing the risk and able to accept the risk and make a good calculation of the risk. Gambling is like, do or die. Okay, if you cannot make it, then you will suffer. So don't ever let investment becomes a gamble. Okay, as long as you track within your affordability level, then you should always be able to have money, okay, to reinvest again.
All right, so let's talk about the second golden rule.
Yes,
which
so,
is why we need to invest.
Not so much as why we need to invest, but the reasons why you invest in a certain company. Okay, of course we invest because we want to have financial security over the longer term, something to help us to build our golden nest when we retire. Okay, but let's look at the reason why you invest in a particular stock. So what drives your selection of a particular stock? Now, you will be surprised that many are driven by rumors without any basis of understanding the reason. Okay, so just as Shane said just now, I guarantee you can make money, and then you'll be so caught up with it because of the word guarantee. Okay, so but do you know the reason why you should invest? Other than it's a guarantee that you will make money. What about the company? Do you know anything about the company? Okay, so for traders, it is always the technical and volume of trade that dictate, that is the reason why they buy into a particular stock. They have certain technical analysis for conformity. Okay, so but if you are new to investment, your objective is to know the reason or reasons for your investment decision so that you are aware of the risk associated with it. Now, if you buy something because someone guaranteed it, you will not think about the risk. But not thinking about the risk, then you have no knowledge of the risk. You have no knowledge of a company. Always remember, as the diagram shows, with knowledge, okay, then you will also reduce the risk. Because if we do not have knowledge, we just invest, then we are absorbing the risk fully. Okay, so that's why always have knowledge behind your investment decision. So how do you start? Now, this is based on my own experience that I always read about the state of the global and local economy. Okay, you must understand global and local trends as the diagram shows. Only when you know what is the global and local trends, then you will know which industry will prosper. Okay, so it will help you understand. When you read about the state of global and local economy, it will help you to understand current trends in the market. And when you know the trends, you will know which industry will stand to prosper. Okay, so that we do not invest blindly. Okay, so this is a top-down approach. Rather than sometimes we just pick a random company, and then how many random companies can you select before you find one that really meets your own risk assessment and also your own affordability? So when you adopt a top-down approach, then you will know that what is the trend that will help the company which is in that particular industry to prosper. Okay, so then all you have to do is to search for the company that stands to prosper most and have the financial strength to weather through the tough times. Okay, so this is an example. Now, we all know that global population continues to grow, and with it, the demand for healthcare, because right now, global population not only is growing, but in a lot of developed nations, population growth is declining. Okay, so which means that the aging population per total population in those developed countries will actually expand and grow exponentially. Okay, now because of that, okay, developed countries they can afford better healthcare, and because of that, okay, healthcare is going to grow. Now, if healthcare grow, then of course products that are involved in healthcare, okay, like glove, surgical glove, okay, then it will also increase accordingly because aging population continue to grow amidst a declining younger population. Okay, so that is why global growth demand is expected to increase 8.5% in 2019. Now, at the same time, US dollar has grown stronger. So Malaysian glove exporters could benefit from a rise in global demand and forex translated gains because they are exported in US dollars. So this is a chart showing the how the US dollar versus the ringgit. Okay, you can see that it is on an uptrend. So these are telling you two stories. One is that US dollar is going up So if I want to make the most of my investment, then I would want a company that have higher revenue in terms of ringgit. So that is when my selection would be, hey, let's focus on export-based companies that have strong international markets. So that already is one decision. But because I also know that global population is going to continue to grow, okay, and there'll be greater demand in healthcare, okay, and growth demand is increasing, then my decision then is, okay, let's look at the growth sector, okay. This is not just to say that, go all in to buy, growth stocks and all those. No, this is just an example, okay. You can also look at companies that have a strong foreign earnings, okay, not necessarily in the growth industry, okay, but they are maybe in the consumer industry. They may be in the high tech industry, okay. So for example, last time I've covered a company called Vitrox. Their equipment is sold across the world, okay, across many countries. So, but then right now, semiconductor is in decline. The market has actually fallen. So then that company, although may have translated in US dollar gain, but then because generally there's a slowdown in semiconductor, therefore its revenue may also be affected. Okay, but how do you know whether it's going to be affected? Whether it's growth or in the high-tech industry? That is why you need to study the financials. Yeah. So what is next after you invest in the company? So always remember, investing in a company is not the end of it. You need to monitor its performance by reading its quarterly report diligently and understand what are the management plans for its future. In short, know the reason why you select a particular company and then monitor the company. Okay. A lot of times we fail to monitor based on our first study of its financials, okay, its performance. Then we decided that this company is evergreen, going to be good. Not necessary. Okay, you need to read the quarterly report diligently so that you constantly are aware the trajectory of the company's growth. Okay, then you will be able to decide whether you should keep the stock for the next few quarters, okay, or sell and take a profit before things got worse. So then you are able to profit from your investment.
So the key idea here is to know why we select the stock and monitor the stock.
Yeah. So the other thing, having selected the company, now we have to go on to key components of a company you should know.
So this is the third rule.
Yes. So selecting a company takes more than guesswork. It is important that you lay down the criteria of what constitutes a good company. Some key components you should consider is the revenue and net profit growth, financial ratios such as current and debt to equity ratio, okay, positive cash flow from operating activities, growth potential, company's 5-year track record, and good management team. Now, sometimes people do ask me, how do you decide whether a management team is good or not? Yeah. Because it's so subjective. Okay. Now, first thing, how do you know a good management team? Number one is that if revenue grow in a smaller percentage, but net profit growth by a higher percentage, then you know that the company is very cost conservative, or they are, or the management is very efficient, so that they are able to reduce costs. Okay, so these are some things that you can learn immediately from the quarterly report. Okay, the more efficient the management is, then they are able to reduce the cost and expenses. The other thing is that what does the management tells you in their review of performance? Now, in the quarterly report, often there's review of performance. Company would say that we have done this, we are doing this. They have constant update. If a company just state the review of the performance without any direction of what they are going to do next, okay, or that updates of what they have initially proposed, and the company just keep it quiet, then you know that the management, okay, is not very proactive towards investors' needs, okay, because they do not divulge a lot Okay, and if that's the case, then that is not a good management team. So when you determine that you are aware of the company, what the management direction is, they are saving costs, okay, they are becoming more efficient, they have plans for the future, what they have done, supported by announcements they have made, then yes, that will be a good management team. Okay. So where to look for the relevant information? Now, revenue and net profit are found in the income statement. Financial ratios can be calculated based on the information found in the balance sheet. For example, current ratio is current assets divided by current liabilities. Debt to equity ratio is total liabilities divided by total equity. Now, debt to equity ratio is also something that you can measure against the management performance, okay, whether it's good management or not. Now, if let's say you have lower revenue growth and lower net profit growth, but then total liabilities over the total equity or the debt to equity ratio is very, very high, then you will know that you will start to question, why is the management incurring so much debt, but then its profit and revenue fails to show? And this will then tell you that, hey, the management is really not that efficient in utilizing their money that is borrowed. Okay, now borrowed money is very important because they are charged an interest. If let's say the management borrow a lot of money, but you can see that it being translated into acquisition of performing assets, you can see that it's being translated in revenue growth and net profit growth, then you know that it's okay, that the company borrows money because they are expanding, their business. But if let's say they borrow a lot of money, okay, but there's nothing to show in terms of revenue and net profit, then you know that something is amiss. Okay, now this is also something which you can gauge the management, whether they are good or not. Now, cash flow from operating activities are found in the cash flow statement. Okay, the income statement, balance sheet, and cash flow statement are all included in the company's quarterly report. A company's track record can be found mostly on the company's website under financial highlights, or you can search via Morningstar, a financial service company. Now, I often use Morningstar because it gives me both local as well as international resource.
Yeah, but for local information, you can also refer to bursa-malaysia.com, because on bursa-malaysia.com there are a lot of all the company announcement will be made there, and you can just search for the company you want to look for and relevant information that you want to look for. Another alternative Bursa Malaysia website, which Bursa Marketplace, that one we have a lot more information for you on the platform. Both platforms are free of charge.
Yeah. So this is an example, okay, of using Morningstar. Okay, like you go to Google search, then you key in company's name, followed by Morningstar, and then you will have the first link there. Then you click this link, okay, and then you are brought into Morningstar. So I use Bitrox. Yeah. So over there, you click the icon on financials, okay, and you have its key financial highlights, and then you click the one below all financial data, and then you will have the 5-year track record, okay, and then you will have all the details, okay, whether you can go to income statement, balance sheet, or cash flow. Okay, so this is how you do it. Now, how do you tell if management is good? To reaffirm again, okay, it is a subjective evaluation, okay, but some hints to identify if the management is good. Always look at cost efficient, net profit growth, outpaced revenue growth, financially sound with low debt, long-term equity growth, okay. So sometimes, when we invest in a stock, we do not only want to see revenue or net profit growth, we also want to see equity growth, because as equity growth, the value of the assets also increases. Okay, so if let's say there's equity growth, there's revenue growth, and there's net profit, there are more positive points, okay, to push a company share price upwards. Then again, the management must have long-term vision, directors with credentials and professional qualifications, especially if, let's say, okay, you invest in construction company, and then the directors, only a few of them are really civil engineers or mechanical engineers, okay, but a lot of them are actually unknowns, okay, or maybe they are they are people in the high society, okay. Then, okay, if you have more people from the high society stage but lesser people lacking in professional qualifications in an engineering company, then you have to be a bit more careful. Okay, if let's say it is an engineering company is housed by people with strong professional qualifications, then that company is managed by people in that line of work with good credentials. So in short, know the company and the people who run it well.
Yeah, yeah, management is really important because if because management is like the captain of the ship, right?
Yeah,
If they really don't run the company so well, or if you don't uphold the highest standard of ethics and
Yeah.
integrity, then all the minority shareholders' money
Yeah.
will be at risk.
Yeah, and
Okay.
sometimes the management will have some very bad practice here. Just to highlight, there was one company I came across, okay, that announced a very high dividend payment, okay, and then a lot of people realized, wow, the dividend payment is so good, and a lot of people bought into that company, but then that company actually have net loss, not net profit. So if a company announced high dividend, but they have net loss, it could indicate that the management is cashing out, by borrowing money or borrowing money to pay for the dividend so that the management can cash out. Okay, sometimes companies like this do happen. Okay, so sometimes don't be too overcome with greed. When you come across company decided to give this huge dividend, check whether the company has the means to pay the dividend. Okay, so these are the things that you should look out for. Sometimes management may be taking an opportunity to cash out. Okay, especially like recently in the global market, there's a lot of IPOs of high-tech companies. Okay, all of the venture capitalists wanted to cash out just as the stock market is reaching a high. Okay, but all these companies are actually losing money. Okay, so then certain IPOs, okay, people will fall for it even. Okay, so these are the things that you should be aware of. So the other one, okay, fourth one, yeah, recognize your limitations. Now, investment requires a strategy, and that strategy has a lot to do with your affordability. You can always as I go along, I always refer back to affordability, because if we extend beyond our affordability, we are actually putting ourselves in a bigger hole. Okay, sometimes we extend beyond our affordability, and even worse, we tend to overestimate the market conditions, and our emotions take over. Now, this is a recipe for disaster. Investment not only comes with an awareness of the risk, but it requires strong discipline. How do you decide, to hold back, whereas someone is telling you that's going to be a guaranteed opportunity to make money? Now, if you are disciplined, you will always have the philosophy of thinking, especially if you are young, you're starting off investment. There's so many years ahead of you. Okay, the one opportunity that goes beyond your affordability is not the end of opportunity for you. You have so many years ahead of you. There's tremendous opportunities up ahead, and as you nurture your investment experience, okay, and you nurture your discipline, then you are able to take advantage on a lot of the future opportunities. Missing the immediate opportunity at hand is okay. It's not the end of the world. Okay, but if you make the wrong decision and go beyond your affordability, then you may suffer such a huge loss that you may not be able to afford to invest for the next few years. Okay, so these are the things that you must be aware of. Okay, so don't ever overestimate the market conditions. Okay, when you are overestimating the market conditions, okay, we call it, addicting towards hopium. okay, because you are addicted towards hope that it will become better. No, everything happens in the market for certain reasons. No, it's not because of any external so-called luck event that causes that stock to suddenly jump up. It happens because of a reason. Okay. Now you must also be aware that even the best laid plans can fall short of your expectations. The key to it, excuse me, is to have patience and not fight a trend. Okay. And Shane always says the trend is your brand. Okay. So don't fight the trend. Okay. If it's on a downtrend, don't think that it will go up tomorrow. Okay. So if let's say the trend is going down, there is a reason for it. So don't buy and hope that it will go up tomorrow. Sometimes patience to wait for the trend to correct itself, then you are able to get in at a much more affordable price. Okay. Or when the trend is going up, the stock price keeps on going higher and higher, then you find that, hey, I missed that opportunity, I must go in now. Okay. But then you don't have that, your affordability level is not there. But then you decided because it's on the uptrend, you cannot miss it. Okay. So then you decided to use your cash reserves to buy into it. Okay. But then because it has been on an uptrend, sell off, then ensure, then you are caught at the top of the trend. And what to do? Okay, you either have to exit or you have to hold the stocks, which means your cash reserves is being used to holding onto a stock which is losing its value. Okay, so always have patience. Okay, now average down is often a strategy that can backfire, especially when it eats past your affordability level. That's the reason why a share price drop. Know the reason first. Okay, this is something that you must always remind yourself. Don't, because the share price have gone down 10%, you buy into it, then it goes down another 10%. So at which level will you be able to continue buying? Most probably, you use your first 10%, the second 10%, then your 20% cash is used up already. Okay, but the stock eventually dropped 50%. Then there's no opportunity to average down anymore. Okay, so know the reason first. Don't just simply average down. So unless you are a seasoned trader or wide margin trading at all costs, because you have already failed the first rule, that is, invest within your means. Okay, you are investing with borrowed time and borrowed money. So sometimes people will tell you, hey, go into margin trading. You make money, okay, on others people's money. Okay, but it's true. But what if you invest and the market started to fall, and then you have to meet the margin call? So either you have to force sell, okay, or even you force sell, you're not enough to cover that hole. What to do then? Then you incur interest charge because there's outstanding amount. Okay, so that's why unless you are very seasoned, okay, if you are an investor, then basically you no need to go into margin. If you are a trader, then some people go for margin. If you are investing for the long-term growth, there's no reason to go into margin. You can just buy at every opportunity that presents itself, so that either you improve your dividend yield or you gradually accumulate the stock that delivers long-term growth in the long term. Okay. So some words of wisdom from John Maynard Keynes. The market can remain irrational, that you can remain solvent. Okay.
Powerful quote.
So it tells you that the market can continue to perform below your expectations, okay, or it can continue to outperform your expectations. But then this quote has a lot to do with performing below your expectation. So then you decide to continue to average down, but then the market still continue to drop. On the other hand, if you are shorting the market, you believe that the market is reaching a peak, then you decided to short it, but then the market continue to goes up, and that is when when you short the market, okay, then you have to pay for it, because when especially in the US, they allow shorting of stock. I think now BURSA also
intraday shorting.
You can have intraday shorting, right? So if it goes up another 10 cents, another 20 cents, then what are you going to do? You thought that it was going to be a bit higher, okay? So that's why, always know that the market behavior can outlast your durability, okay, and affordability.
So the key idea is that no matter how confident you are with your judgment, okay, always respect the market. Because even though you feel, oh, this stock is definitely going up, you're so confident with your view, you study all the fundamentals, you think that this market is going to go up, but if the market go down, all in, sometimes you could be right in your judgment, but maybe you're wrong in the timing. The judgments could be right, but then the timing could be wrong. So this will ring a bell to you that the market can remain irrational, then you can remain solvent.
So eventually, that's why people lose money in the stock market, because they are betting against a trend. Okay, and that trend, okay, sometimes remains very stubborn. Okay, if let's say that's why a lot of people lost money during the global financial crisis, because when the market dropped, they always believe that this must be the bottom. Then it dropped again. This must be the new bottom, but then continue dropping. So that is why you will never ever able to know when is the bottom. Okay, so later I will share with you how you can buy near the bottom, and that's a technique to it. So the fifth one, buy the rumor, sell the fact trap. So rumors are plenty in the stock market. I think those seasoned traders, those seasoned investors will often tell you, someone they know, someone their friends say, always they say, but someone will always have something to tell you that they have inside information. Okay, now some are baseless, while some eventually are proven to be facts. Now be wary when someone shares with you he or she has inside knowledge. Professing to have inside knowledge without the company divulging it to the public is illegal. Okay, it is a contravention of the rules set up by the Security Commission. Okay, so that's why directors who partake in insider trading, they can be fined or go to jail if severe enough. Okay, so when we hear this kind of thing, always remember the persons who started the rumor had already bought huge volume in anticipation of the rumor mill playing its rounds. It's whether you are at the beginning of the rumor or towards the end of the rumor. Okay, so by the time the rumor reaches you, it is often stale, and you could have bought the stock on a high where the persons who started it have sold into the rally. So these are things that a lot of people get trapped in. Now, what to do when you hear a rumor? Read if the company has any prior plans announced that is closely associated with the rumor. This is something that you must always check. Has the company previously announced something that is what you are hearing now? Okay, that there's some progress in it. If yes, then there could be some inkling of truth in it. However, you need to check whether there has already been a run-up, whether there has been already been a run-up in the share price, as it could mean traders and investors have already established their positions, and therefore any upside potential will be limited. Okay, so that's why when you hear a rumor, and it gels with what the company plans are, somewhere you have read in the previous announcement, then you look at the stock performance. If let's say the stock price have moved up quite a bit, do you really want to go in at this stage? Okay, so if you go in at this stage, then maybe you'll be towards the end of the rumor mill already. But if let's say it's just started, then yes, you hear it and then you check, it's something that is related to what the company has previously announced, but then the share price is just started to move up, then you might want to make a bet on it. Okay, but if let's say there's no relation of that rumor to any plans that the management has previously announced that is similar to what you hear, there's no relationship at all, then it's best to ignore it. Okay. So this happens by the rumor sell the fact trap. It happens all the time to a lot of people. Even as the rumor has some basis, just as you have taken a position, the company make announcement and then the sell-off starts. Okay. So because sometimes when there's certain irregular movement in a particular stock, BURSA will actually send a questionnaire to the company and ask, are you aware of anything that has, caused this kind of price movement? The company must actually divulge. So sometimes companies say they are not aware of anything. Okay, if the company is not aware of anything, then there's really no basis in it. Okay, so that's why when there's no basis, then the sell-off would start. Normally, company would say there's nothing that they are aware of. Okay, because if they are aware of something, it's the company's fiduciary duty to actually announce it to the public and not to keep it under wraps. So that's why company often say there's nothing that they are aware of. Okay, so even worse, the rumor has no basis, and when the company comes out to clarify, the sell-off ensues and gather intensity. Okay, this is because your action is dictated by emotion and not by logical assessment. Okay, so then you have a buyer remorse. Okay. On rumors and facts, in any investment, study the facts, for they will lead to a logical conclusion. But keep your emotions in check, for they will lead you to many illogical decisions. Now, this is something which I thought of when I wrote my book, Invest in Risk, in 2015. Okay.
Very powerful quote.
So I think always look at the facts. When you look at the facts, your conclusion will be logical. But if you let your emotions take over, you will make a lot of illogical decisions. Okay. So what to do when the rumor reaches you? It is important that the rumors are verified. If not, it is better to give the stock a miss. In short, do not listen to rumors. Often they are stale news by the time they reach you. It is better to be safe than sorry. Okay, so always remember when it comes to rumors.
Yeah, don't listen to rumor.
Yeah. So the sixth one, average down.
Golden rule.
Trap and techniques. Now, average down to me is always a two-edged sword. Why? Because a sword is sharp on both edges. Okay. If you average down and then the stock price eventually went up, then you can exit with a profit. But sometimes we average down and then the price went down further, and then your losses actually increase. So average down can move both ways. So why average down is a two-edged sword? Now, one example 3, you buy 1,000 units of company A at 1 ringgit each, total of 1,000 ringgit investment. You buy another 1,000 units of company A at 80 cents each, total of 800. Now the average price per share is 90 cents because 1,800 divided by 2,000 shares. So company share price then climbed to 120. Your profit will be 2,000 times 120 minus 1,800 ringgit. Then you make 600 ringgit in profit. Now the other example is that you buy 1,000 units of company A at 1 ringgit each. Okay. Then you buy another 1,000 units of company A at 80 cents each. The average price per share is still at 90 cents, but then company share price fell to 60 cents. Then your loss, okay, would be 600 ringgit. So it is not easy to predict the bottom. Neither is it every time when we average down, it's bound to yield a gain. Okay. So what causes the share price of a company to drop? When the share price of company falls, it could be due to the following reasons. Okay, weak market sentiment domestically, a global sell-off that triggered the local market, company quarterly performance was below expectations, and company is in financial distress. So it is therefore prudent for you to determine what is the root cause for the drop in the company share price. When the company share price fall, you immediately decide to average down. There is a reason why it happened. If you average down without knowing the reason why, then you are partaking in a game of chance. Okay, always remember, investment always comes with certain discipline and determination of risk. Okay, so when average down works, if the company is financially sound and its growth potential remains intact, then it is an opportunity to average down. Average down only when that company has meet this kind of criteria. Even better if the company has a history of paying high dividends, because an opportunity to buy at a lower price ensures a higher dividend yield in the next up cycle. So you take advantage of that so that your yield actually improves. Now, it makes more sense to average down when the share price falls 20% than to average down at every 10% fall. Okay, because if you average down by 10%, every 10% fall, by the time you reach 50% fall, you have already bought a lot of shares. Why not you just buy when it average down, more than 20%, when the share price have fallen more than 20%. So when average down doesn't work, if after you have averaged down, the share price continue to fall further, even though the company has good potential, it is best to stop averaging down because it may eat into your affordability level. So even as the company is good, okay, and the share price continue to fall further, it has nothing to do with that company, but it has a lot to do with market sentiment, and also could be triggered elsewhere in a global sell-off. So in this instance, market sentiment is overwhelming bearish, and it is best to take a breather. Don't go in. Okay, it is impossible to ever determine if a bottom has been reached. So we do not know where is the bottom. It's very easy for people to tell you buy low, sell high. Everyone knows how. Okay, but then how do you buy at the bottom? You can never predict it. Okay, some people are lucky. Okay, and then the share price went up drastically, and then they live to boast about how they are able to anticipate a bottom. But I have never been successful in anticipating a bottom. Okay, only resume your average down when the company share price has recovered from a bottom and has remained consistently above it. Then that will ensure you that you are not investing in a dead cat bounce. So sometimes when the share price has fallen substantially, technically the share price might recover, but then it will fall back again. Now this kind of minor uptrend followed by a fall is often called a dead cat bounce. Okay, it bounces once and then it falls further. Okay, so how do you determine whether if you invest now, that it will not be a dead cat bounce? So that's why you need to test the sustainability of that particular share. Now, this is an example of Cal between May 2006 and May 2010. This is, of course, in the middle was the global financial crisis. So let's say, assuming you bought at 15 ringgit, okay, and then it went up, but then it started to fall. Then you make your first average down. Remember what I say about being more than 20%, 20 or 20, more than 20%. So then 20% is 3 ringgit. So we average down and it reached 12 ringgit. But then it falls further down. That is when I think you should totally give up. Okay, don't chase the stock to the bottom. Now, after the downtrend, the company actually start to rise consistently. So in which case, then the second average down will be at 11 ringgit and 60 cents, 6 months after the bottom. If you are more acceptable towards the risk, you need not wait 6 months. You can also look at 3 months. Then yes, maybe you are able to you can average to another average down at about 10 ringgit. So that's why, once you have bought into a share, you make your first average down and then it falls further, you do not know what's the bottom. Now, in this case, Cal is a very strong company, financially sound, okay, and has tremendous opportunity for future growth, okay, during that time. So, but if you continue to average down all the way to the bottom, you will have accumulated a lot of shares, okay, and therefore, okay, when you have accumulated a lot, then there's also an opportunity cost, because some shares, some of the money could be used to buy into another company that grow even much faster. Okay, so there's always some opportunity cost. So this is one technique which you can use. Okay, that after a bottom, has been reached, then look for price sustainability over a period of about 3 to 6 months. Okay, so adopting the right attitude. Know the reason why the share price declined. Averaging down through ignorance is akin to throwing good money after bad. Okay, so that is why sometimes people, even when they average down, they continue to lose money because they are throwing good money after bad. So the last one, have a balanced portfolio to reduce risk. Now, why is it important to have a balanced portfolio? Investment carries with it certain amount of risk, such as risk of company not performing well, risk of government policy that impacts a particular industry, risk of change in consumer behavior or spending pattern. For example, I think the most prevalent now is online shopping. Okay, before people would go to shopping mall and then buy through the cash register. Okay, but right now a lot of people are going shopping at the comfort of their own home. Okay, and therefore, consumer spending behavior is changing. And previously, okay, people go to arcade game hall to play video games, okay, or they go to internet cafe to play games. Right now, you download an app, you can play games on your mobile phone. So that's why the internet cafe is a dying business also, okay, because change in consumer behavior. So there's also risk of disruption caused by new technology, okay, which I've mentioned just now. The introduction of mobile gaming through mobile apps, okay. Then there's also risk of recession and crisis. Now your portfolio needs to be balanced, so your risks are spread across the portfolio, therefore minimizing them. Okay, adopting a risk management, how do you go about it? When you are aware of the risk, you can plan for them. Adopt an inquisitive attitude and analytical approach when you select your stock. This is the most basic in risk management. Now, those of you who have worked in corporate multinationals, often they have a risk management team. They will ask you to list down, okay, what are the risks you foresee in your own department, okay? Just as you are asked to make some risk assessment of your own department. Well, in investment also, you need to make some risk assessment as well. How do you want to spread your risk? Okay, so set out the parameters or KPIs to help in your decision making. For example, revenue growth. Okay, I'll be looking, these are some of my own KPIs here. Revenue growth must be more than 5%. Net profit growth must be more than 10%. Current ratio must be more than 1, debt to equity ratio less than 1.5, PE ratio of less than 15, operating cash flow must be positive, share price over net asset value cannot be more than 3 times. But then, sometimes you will have a kind of confusion. Okay, when company exhibits strong revenue growth, strong net profit growth, tremendous amount of cash flow, okay, debt to equity ratio low, current ratio very high, but then PE ratio very high, could be even 30. Share price over net asset value maybe even 20. Now, if this is the case, then you look at it. Out of these 7 criteria, the company has met on very key fundamental stuff of 5, strong cash flow, revenue growth. Then why is P ratio and share price over net asset value per share is very high? Because these are high growth company. So high growth companies sometimes exhibit very high PE ratio. It doesn't mean that because the PE ratio is very high, okay, then you do not want to buy. Okay, so because high growth company, people invest over the next 5 years or 10 years to see the real growth. Okay, especially IT based company. And that is why they exhibit very high PE ratio and share price. But if let's say the other fundamentals have a lot to do with money, okay, in revenue growth, net profit growth, current ratio, debt to equity ratio, and strong cash flow, then perhaps it's worthwhile to then invest, okay. But then at least you know that out of 7, it hits 5, so there are more yeses than nos. So when you start in building your own portfolio, you need to ask yourself these questions. How much loss can I stomach before I decided to cut the losses? Okay, because if you buy a stock and you lose money, and you always say that it's okay because it's a paper loss, I keep on holding the stock, then that is opportunity cost, which means your portfolio will always be holding this stock that lose money. Rather than selling it, divert the cash into another stock that actually help you to generate profit. So you have to ask yourself this question: how much loss can you stomach? Okay, because otherwise, if you are sailing on a ship, you want the ship, okay, with a crew that can make the ship more efficient and make it go a longer distance. But if you have a very weak crew, okay, a crew that is sick, then that ship is your portfolio, okay. Journey will be much shorter and not able to reach your investment target. Okay, so also ask what is your target price. Knowing when to sell help you in your cash flow. Okay, so you are actually, when you look at this cutting losses, cash flow, you are actually treating your portfolio like your own business, and that's the most important thing. Treat your portfolio as though you are running a business. So if you are running a business, you have to ask yourself, if you are a businessman, okay, if your inventory is nearing expiry, do you still want to keep it? You might as well sell it so that at a discount, so that you get money in to really buy other new goods. So that's why knowing when to cut losses is important, and knowing when to sell is also important. Because if you keep on hoarding but you don't sell, your cash flow is going to be consumed by hoarding. There's no more money to recycle back into other new products that can help your business grow even better. So that's why knowing when to sell is also important. Then also ask, what are your strategies in the slowdown or recession? No market ever goes up on a straight line. They come in cycles. So you must have a balanced strategy. If slowdown, what do I do? If a recession, what do I do? You must have certain strategies. Okay. So for example, if let's say there's a slowdown or recession, what I often do is that I will start looking at what are the high-paying dividend stocks, so that, but then of course it must not be too expensive, yeah. But if let's say it is a high dividend yield that meets my criteria, okay, then I say I will put some money in this stock, so that in a recession, okay, this company also would have steady income stream, okay. And there's also other stocks that are very recession proof. Okay, for example, in the utility and certain consumer goods. Sometimes people say, for example, Nestle. If you take out Nestle, 70% of the supermarket shelf will be empty. Okay, because the consumer goods is so wide ranging. Okay, and those are basic necessities like milk. Okay, even nowadays Maggi noodles is also a necessity. Okay, so these are some things that you have to think about, and how do you want to position yourself ahead of a slowdown. Okay, so what are my strategies in the recovery and expansion? Okay, so when the time is right for the market to go on an upcycle, okay, you can always look at going back into high growth IT based stock, so that then you can actually ride on the upcycle. How do I allocate my funds to different type of stocks? What type of stocks should have priority? So when you know all this, okay, then you know what is going to happen and you are prepared. Now the diagram below show this is what happens when you are unprepared. The risk keep on mounting, and you're finding, you are just using all your resources just to hold up so that the risk wouldn't make it even worse. Okay, but because the risks are so overbearing, eventually it will come down and collapse you underneath it. Okay, so what is a balanced portfolio? Now it should provide you with steady and passive income, stocks with good and consistent dividend payment. Okay, it should offer you some form of a hedge. For example, gold ETF. Now this is important when there is a recession or a crisis, because if we look at global recession, then central banks would be printing money. So as they print more money, the fiat, we call it fiat currency, okay, would lose its value. And then gold, which has been money for 5,000 years in history, would then actually perform much better. So this is one form of a hedge. Okay. The other hedge is that you can do like BURSA now has a bit more high risk. Okay, but if you are new, I think I wouldn't encourage it because you will not be it will be more risky to you. Okay, it's the inverse ETF. Okay.
BURSA not yet have, but it's about to roll out.
Going to roll out.
Should okay. We don't know when yet, but I think there are plans.
Oh, the last time they mentioned about it. Okay,
Yeah.
so but then this is often a very high risk stuff. Okay, but if you are a newbie, okay, you shouldn't go for high risk stuff. But then you can actually hedge with the gold ETF. Okay, it should also provide you with opportunity to grow your portfolio. Okay, these are the growth stocks which can multiply the amount invested within the medium term. Okay, for example, some high tech stocks, they have grown, more than 10 times or 15 times over the last 10 years. Okay, when you average it out, that's 100% per year. So these are the stock that you want to invest in as well, so that you have steady dividend payment, you are properly hedged when there's a recession coming, and then when certain high tech stocks in the recession, they have been brought down very low in price. Okay, but then they have good future, they are financially sound. Then when you invest in them in the next up cycle, then you can enjoy tremendous growth in your portfolio value. But they could also be subject to massive sell-off in times of recession and crisis. Okay, because the last thing people want is security. So when crisis comes, people sell all the high-risk stuff. Okay, and high-growth stocks. And IT stocks eventually will fall into this category as well. So therefore, going back to what I said earlier, you must know when to sell. Okay, if you are new, then it is prudent to start your investment with dividend-paying stocks so that it allows you to increase your affordability. So don't go about, building portfolio doesn't mean you immediately start to have, 5 or 10 shares. Okay, you start by one. Okay, start with one that allows you to enjoy dividend payment so that you can increase your affordability. But remember, always manage your risk. So this ends my presentation. Is back to question and answer session.
All right, so thank you so much, PC, for your enlightening 7 golden rules in investment. So now we are opening up for questions. If any question to ask the speaker today, please write down in the question box and remember to write in full sentence. Okay. So now the first question on my screen is, do you think a high debt company with fast growing business is a good company?
If let's say the company is high debt, okay, but it is shown to result in terms of revenue growth, in terms of net profit growth, then it is worthwhile to consider. Okay, it must be reflected in the high revenue and net profit growth. But if let's say it's high debt but there's no revenue growth, is very low, then I would think that the risk is much higher. Okay, and when it comes to high debt, again, it goes back to the debt to equity ratio. For example, if let's say debt to equity ratio, now my criterion is actually 1.5. If let's say it's between 1.5 and 2, I may still be able to accept. But if let's say that company debt to equity ratio is 10, okay, then I begin to get very worried. Because if net profit growth, unless the net profit growth is few 100%, okay, then maybe I say, okay, it's worth a chance. Okay, but how do you determine that? For example, annual net profit, okay, is, let's say, 1 million. Okay, but then the long-term borrowing is 30 million. So then when you assuming that the entire net profit is used to pay off the debt, it takes the company 30 years to pay off its debt. Then I began to worry. So sometimes you can check back this, you make certain assumption. If let's say assuming the entire net profit is used to pay off its debt, how many years? If it's 30 over years, then it's quite ridiculous. Normally I look at something that is within 5 years. If let's say it takes more than 5 years, I begin to get worried because a lot of things can happen in 5 years, especially when you look at the economic cycle. okay, every 7 to 10 years, there is going to be a downturn, traditionally, okay? So historically as well. So that's why, if it cannot repay its debt within 5 years, then I know that if recession or slowdown starts in the next 2 years, then this company could be a problem. So you just make that assumption, the entire net profit to throw back into paying the long-term debt, how many years it is, then that will also help you to assess whether that meets that kind of requirement or not.
All right. So now the next question on my screen is, what is your view about sell in May and go away and buy back in July?
Sell in May, go away. Sell in May and go away has a lot to do with cycles. That's because what happens in the US. Okay. Now there is a lot of cycles that sometimes it happened. Okay, previously, but right now it's much more difficult to predict. Why? Because central banks in the Western nations, they are very afraid of the stock market collapsing because there's so much debt that is used to prop up the stock market. So they continue to try to ease, the financial conditions so that the stock market wouldn't fall. But then when they ease, people take in more debt. So that's why it becomes a very vicious cycle. So sell in May and go away. Okay, may not necessarily be happening. Okay, but certain times, it could also be due to, for example, June is the holiday season. That's why people want to sell. Okay, take off because their summer season holidays is quite long in the Western nations. So they want to take profit. That's why they sell, so that during their vacation in the summer, they do not have any worry that the stock market suddenly tank and all those. Then they are on holiday. How are they going to sell off their portfolio? So that's why it happens. Now, then again, why they buy back into July also? In August. Okay, because November and December is where a lot of the fund managers can claim their bonuses. So push up the stock market. Okay, when they come back from holiday, push it up, then they sell in November and December. That's why towards end of the year, there's often a sell-off. Then before the year starts anew, we call it window dressing. They sell and then reposition their portfolio. But it's also they sell because they want to claim their bonuses. So that's why there's this kind of trend normally. It's associated with certain cycle behavior. Okay, but right now it becomes rather vague because a lot of central banks are propping up the market in the Western nations.
Yeah. And not only the summer in Western nations is longer, the summer in some of the Eastern nations is also longer, like China. Usually, summer break is longer. But anyway, let's go back to our Q&A sessions. The next question on my screen is, if we are new to investing, can you give us like some example of dividend stocks?
If you are very new, look for the one that is the lowest risk. And I think that to qualify that, I think it's better to start off with REITs, real estate investment trust.
Where you are the expert. Yeah.
because real estate investment trust in Malaysia, there is certain rules and certain guidelines. For example, to qualify as a REIT, they must return 90% or more of their net income to the unit holders. So that ensures you have a good dividend.
That is to qualify for the tax incentive.
Yeah. The other is that the gearing ratio of REITs is limited to 50% of their total assets. So a particular REIT cannot take overwhelming high debt because they must meet that gearing ratio as a requirement. So that is the safest. Okay, and meanwhile also allows you to enjoy some steady income. Okay, so you start on a low risk platform first.
Okay. All right. So I have a long questions on my screen right now. So let me briefly read it to you. So let's say we have a budget of 1,000 ringgit, and we see that there's share A, which currently traded at about 5 ringgit per share, And after we read the data and analyze the company, we realize that the business is doing good. Now, so the question is, should we buy should we go all in to buy 200 shares of this company, which is 1,000 ringgit, or should we allocate maybe to buy probably buy 500 ringgit first, then save another 500 ringgit,
Okay.
average down. So this is the question from one our
Yeah.
audience, and then the following up question is it worth? Because if you have small amount of budget, a small amount of capital, and then we split to two tranches kind of thing.
That's a very good question. And sometimes our investment is not necessarily, driven by just what we read. And remember what I say about the reason why you invest. We start with global trends. Now, what is the global trends telling you right now? Recently, the IMF has revised global growth from, I think, 3.6% to 3.3%. So even the International Monetary Fund is projecting that there's going to be global slowdown. So if you are aware of the global trend that is slowing down, okay, then would you want to invest all your money into a possibility that global slowdown will actually impact upon stock markets worldwide? Okay, so that's the first thing, you need to ask yourself. If let's say you believe that the global slowdown will impact emerging markets like Malaysia, then you might want to split. Okay, that I buy something now because it's really good, so that if let's say it continues to go up, I can make money. Okay, or you keep this 1,000, you wait for signals to show that global slowdown is actually getting worse, and therefore you hold this at the right moment, and then you can buy more units, not just 500, because the share price have actually fallen. So actually it depends on your own risk assessment, whether you want to take a higher risk to invest right now, or you want to wait and see. Okay, but as I mentioned, if let's say you want to start off, okay, look for something with some steady dividend income, so that even when you invest in that, and eventually the share price fall, at least in your first investment you start earning dividends, and then the damage is much lesser. Okay.
All right. So the next question is, how much should we risk for each stock in our portfolio?
Sorry.
How much should we risk for each stock in our portfolio?
You need to. It's very difficult to quantify risk in that manner, but what you can do is that you can distribute your risk. Okay. One thing that you can immediately minimize is actually have stocks that, like I say, REITs, okay, real estate investment trust, that would severely minimize your risk exposure. Then only you look at some blue chip, okay, so that the risk may be higher than the real estate investment trust, but then they still pay a dividend. So when you're starting off, you need to look at dividend paying stocks first. And because right now the global economy is really not good, as I mentioned, IMF is already cutting down forecasts. Okay, growth-related companies will be the first to be impacted, because growth normally people buy for the future, people don't care for the dividend. Okay, so when there's a slowdown, and growth companies will be the first to be impacted because people want to sell off. But then dividend paying stock may be a crowded trade. Why? Everyone want to move into dividend stock so that they can enjoy dividend while they wait out the recession or slowdown. So how you appropriate your risk, okay, you should go into this kind of selection process.
I see. So the next question on my screen is, why sometimes the good dividend yield company, the share price slowly drop?
Now, some dividend paying companies, okay, what happened is that when you have a company announcing dividend, the share price would normally go up a bit, up to the value of that dividend. For example, if the company is paying 10 cents dividend, yeah, the company share might go up 10 cents or 20 cents. But then as soon as the dividend is X dividend, then the share price will normally drop because people would minus out the 10 cents from its value. And then it might drop much further because because that company, other than the dividend, there's nothing very much exciting about it, especially when it comes to real estate investment trust. Real estate investment trust, the stock price, hardly move in a very there's no huge gap up or there's no huge gap upwards. Okay,
slow and steady type.
Slow and steady type. It's based on the company gradually accumulating assets, acquiring assets to deliver. Okay, over the longer term. Okay, so some stocks are not exciting. Okay, and some stocks, even if they are paying a high dividend, but then the share price still drop, then that could mean that the company has underlying fundamental problem that investors are not interested, or investors think that they are risky, even though they are paying a dividend. So you need to go back to the balance sheet, its income statement to find out, is it because it has too much debt, or is it because that the dividend is being funded by debt? Then people would be not interested. Okay.
Okay. Now the next question is, what is your recommended cash to stocks ratio? Like how much cash should I keep in my portfolio, and as opposed to how much stocks?
I think just now when we go back to the earlier part, you no need to put in cash as part of your portfolio. You immediately separate out cash. Okay, as I mentioned, 20% of your salary cash for whatever emergencies and all those. Okay, but once you have started your own portfolio, okay, you should really go towards growing it. And at certain point in time, okay, for example, the market outlook is weak, okay, then you might want to keep certain amount of cash. Okay, now for that kind of cash that you hold, okay, it depends on, again, back to your own risk assessment, that you want to buy more, okay, then you may allocate that I want 50% cash right now in my I sell off everything. Okay, my stocks, I want to hold 50% cash, because in the next down cycle, with this 50% cash, I can buy a lot of stocks. And then and when they start to go up, okay, I can make, let's say, 150%, because the share price have already been beaten down. Okay, so that depends on your own risk assessment. Because if you hold that cash, you must also understand that even if you put an FD, the rate is very high. So sometimes, that's why I say you need to have certain low risk investment, for example, REITs. Okay, if they pay a distribution, normally it's much higher than the FD. So even if you hold, then you need to decide whether that maybe I should have 50%, instead of 50% cash, I have 30% cash, and then 20% I put into REITs, or maybe 20% I still hold as cash, 30% I put into REITs, so that then the distribution yield that I get from the investment, the real estate investment trust, is still much higher than the one you put in an FD. Okay, and for real estate investment trust, because they don't get upwards very high, just as they won't get down very high, very large difference as well during a recession. Some based on certain averages that I study when I wrote my book, they often in an economy during the global financial crisis, they moved down about 20 to 30% in price at the most. Okay, unlike stock, it can go down to 60 or 70% for some small cap stocks and high growth stocks. Okay, so then if let's say you when it goes down about 20 or 30%, you can then buy some more so that your yield improve further when during the up cycle. So actually, again, back to your own judgment, how you want to allocate it. Yeah. So again, depends on your own risk assessment. Yeah.
All right. So next question is probably the last question. Is that what do you think of companies with a huge percentage of shares owned by certain individuals or the family members?
I think for a lot of Asian countries, yeah, family ownership is a very common thing. Um, if you if you look at a stock, I think it is much better to have some institution participation. Okay, which means there are certain foreign institution or large local institution like KWSP, okay, investing in a particular stock, okay. But if let's say it has high family orientation, then you look at the board of directors. If let's say the board of directors are mostly under the same surname, okay, then I'll be quite worried about this company.
You'll be quite worried.
I'll be quite worried. Why? Because everything is within the family. There's no outside external feedback. Sometimes all in the family may not be a good thing, okay, because there's some conflict of interest, okay, and traditionally lah, okay, there's also some vying for uh, inter sibling competition, okay. So I would look at company that even though it has a majority share, okay, in the family, but then the board of director have the board of director is very well rounded, all rounded, with different people from different backgrounds, okay, and not related to the family. Then you have better input, and better integration and motivation. Because sometimes within the family, companies that are very family centric, they wouldn't think so much about the shareholders sometimes, okay, because they think about how the family gain first.
How to enrich themselves.
Yes, not how to give value to the shareholders. And that's why we have over the course, if you look at family business that eventually are delisted or under PN 17 and all those, a lot of it are actually very family orientated because they overextended themselves, or like just now when I share with you a company that borrow money to pay for dividend, it's also family orientated because all the shareholders want to enrich themselves and get out quick. You see, so these are the concerns that I have. Not that all family orientated companies are very bad. So you need to actually look at it that even though a family is the majority shareholder, if let's say it's run it's a family-owned foundation, then it's not that bad. If let's say their CEO, is an outsider, then which means they value persons who create value.
Okay. There are also attendee pointing out that there are a number of companies, Chinese company, coming to BURSA to list. Then eventually, a few years later, say that the profit they are showing losses. Then it eventually got delisted.
You have to be very careful with Chinese companies because I invest quite a lot in Hong Kong-based Chinese companies as well. I often look at companies that are very big, not the small timers, okay? Because the small timers, sometimes they are well known to fudge their accounting, okay? So you need to go for the big ones, okay? Or those that have very low debt, okay? Very strong cash flow and so forth. And if you have those companies that is very low in debt, okay, then the risk is lower. But sometimes they also fudge their accounting books. Okay, so there's always this risk because when they enter into a certain market, sometimes they will also think how to make money fast as well. So they need to be very careful, okay, and their business must be something that is worthwhile and longer term. So I reduce my own risk by having more of companies in my portfolio that Chinese-based companies, that are have very long years of operation. Okay, so if let's say a company is newly listed, okay, wait a while, look at its financials first and so on. Sometimes we think that, wow, China is growing and this Chinese company is listed, is coming to list, why not I better join in the bandwagon? Then, you might be disappointed. So invest only those that have demonstrated strong potential growth over, have a track record. The other thing is that either they are either that, or if they are newly listed, they are part of a bigger conglomerate in China, which means it's part of a Fortune 500 Asia company, with very big background, foundation and strong support from their holding company. Then you might consider, if it's unrelated, it's new, watch and see first.
All right. Thank you, PC, for this wonderful sharing. So, with that, thank you so much for being a wonderful audience on today's webinar.